It's not just how you sell, it's what you sell. Now, what do I mean by what you sell? So here's the thing. Final expense is a great business, but not all carriers look at underwriting parameters the same, and certainly not all carriers are priced the same. When you combine that with a market that is price sensitive, more so than I would say the average middle class environment, we're typically working with final expense prospects who are low income, disability is very common, working class, people who maybe have a very little bit of savings, if any at all, and they're living mostly paycheck to paycheck. And you combine that with an elderly population base, 50, 60 and older, that probably has health conditions. If you walk into a final expense prospect's home with one carrier, sure, it's easy to sell one company with your captive insurance agency, but the consequences is you're product pushing. You're not going out to the market to see which combination of price and coverage serves the client best. No, what you're doing is pushing a product that almost never is the best combination of price and coverage. It's better than nothing. If a client can get a policy approved, better than it was before. So there is to say that. However, the issue at hand is that in the next 90 days, you can almost guarantee that I'm coming in behind you or another agent's coming in behind you to look at that policy, do an analysis of it, and then try to replace it if the agent feels that the client could be served better. Think about it. If I walk in and I see a client with XYZ insurance company, they are on a 2-year waiting period policy. They don't get any natural death coverage for the first 2 years. They're only 3 months into it, so they got another 21 months to go. They have COPD. They're not on oxygen. And yeah, they may smoke. That company, in this case, if the client dies, is not going to pay the full death benefit. They're also paying through the nose. Because I have multiple products, pull out a carrier and offer the client first day full coverage, immediate natural death coverage from the first day. And on top of that, the price is a little bit lower too. What do you think? Your fixed income clients with health conditions that are worried about paying final expenses that now realize that there's a waiting period, what do you think they're going to do? 8, 9 out of 10 times, no matter if you are the greatest and nicest agent ever, they're going to dump your plan and buy from me because it just makes business sense to get the best value for the bang a buck that they have to invest, right? Because they're on a fixed income. They can't just flippantly throw their money around. And this is the consequence of what happens when you're with a one product company. And the outcome is that when you're pushing product, and it's almost never the best combination of price or coverage, your persistency rates drop. Remember that term, the amount of business you sell that doesn't stay on the books. So your kept rate is lower. So that means and translates into a lower net income. You're not making as much per month because there's a higher number of clients you're losing because of your inferior policy. Add to that, if you're just selling one product and not a multitude, there will be circumstances where you'll walk into other opportunities to replace, but because your product is high priced or not good or all encompassing on underwriting, that you will lose a sale you could have otherwise gotten. And there would have been an easy sale, but because you couldn't do better, too bad. Whereas if you were an independent agent, what happens there is you can sell more of those deals because you have options. And likewise, the inversion is true as an independent agent with multiple products. What you sell tends to stick better, assuming you also sell well too. So if another agent comes behind you and they see you've sold a competitively priced product, no bueno, you're not getting that deal. You're not replacing that deal because you don't have the capability to do it because it's a good value. I'll give you a quick story. I was down in Gadsden, Alabama many years ago, and an appointment I ran, I discovered a client had a family benefit plan, $80 a month, and it was about a year or so old. And what I realized is that after doing some pricing, the client wanted more coverage for a better price, like a lot of our clients do. There was no way after reviewing pricing options I could replace it because family benefit Trinity Life is so competitively priced. Even if this client wanted to replace it, there was no way. And I had like 15 companies at my disposal. So I walked out of the home not being able to replace the policy because in this case, the agent wrote a good company that was priced well and couldn't be replaced. And that would have been a lapse to that client, but that agent, but it wasn't because he did the right thing and sold the right policy. So all of this is to say this. This is another way to control and reduce chargebacks. Sell the best policies. Sell competitively priced companies. Have a diversity of carriers that have underwriting niches so that when you walk into a client's home, what you sell actually sticks. And that you can also improve the client's coverage by replacing inferior coverage with better coverage more often.